Hello and welcome to Joy in Our Town. I'm your host, Vanessa Rose. Thank you so much for tuning in and joining us today. Today we are very happy to be joined by Dean Wegner, and he is with Academy Mortgage. And today we're going to be speaking about economy. Thank you so much for joining us today, Dean.
Thanks, Vanessa. Thanks for having me.
Such a pleasure to always have you. You always have just a great plethora of information that our viewers just love to hear and things that apply to so many people. But before we get started in our program, if you wouldn't mind sharing a little bit about yourself and what you do and why you do it.
Okay, awesome. Well, I've been in housing for 20 years actually this month, and I have 3 awesome daughters, and I love to explore Arizona just at Lake Powell, Sedona, and just get out and see the beautiful state. And that's really it. I'm kind of a nerd. I really like everything we're talking about today. So I, eat and breathe real estate and housing and all that information. So I love it. Yeah.
Wonderful. So how long have you been in this business then?
Well, close to 20 years. I've been a certified consumer credit counselor for about 10 years now, and I help people just coach them on how to, get back on their feet. I wrote a book, Life After Foreclosure, which helped a lot of people. I think that's when I was on your show before, just helping navigate the waters after foreclosure or short sale or bankruptcy. And people have a lot of questions. They're very confused, and especially at that time there's really no place to go. You could go on hold at your mortgage company or ask somebody at work, but at that time there was absolutely no leadership for people that were struggling with their home loan. And so I wrote the book, and it's still for sale nationwide and things like that, so it helped a lot of people. So it's awesome, and I just love to help people.
And that's something that I know probably so many people enjoy reading, because credit and foreclosures and all this, it's kind of this big question mark, I think, to the consumer, where we, as a consumer, you look for things and there's so many resources, but you don't know what's which and what to find and where to go. And so that's really neat that you're able to help people that way. Yeah. I'm sure that many people appreciate you. So thank you so much for joining us today. And thank you so much at home for watching. Today we are discussing economy, and our first topic is after foreclosure. Before, just really basic, before we even get into what we do after foreclosure, what is a foreclosure?
Well, a foreclosure means you bought a home and you financed it. You had a mortgage on it that you were making monthly payments to. And for whatever reason, whether it was a hardship or in some cases, especially in Arizona, you had strategic default, but for one reason or another, you discontinued making your monthly payments. The lender gave you notice. They may have some concessions to get you caught up or something of that nature. And at the end of the day, what happened is ultimately they took the house from you. And so that was the collateral that was negotiated in your mortgage contract. If I don't make the payments, you can take my house. So that was clear up front from both parties. So a lot of people have this moral dilemma like, oh my gosh, I can't lose my house. Well, the bank already made an agreement with you in writing. Should you not pay, they're just going to take your house. So it's not the end of the world. So a foreclosure is when the bank takes your house from you.
And everybody has different contracts to how long you have to go without paying before they can take your house, or is that a standard?
It's actually statutory here in Arizona. So yeah, it's really set by the state on how long it is that they can take your house. So typically, just recently it was up to 6 months, and now it's leaning towards 10 months because of some new regulation that came out to give people more notification that you're going to get your house or they're going to take it from you.
So if somebody were 10 months behind and they wanted to keep their house and they were close, can they go back and save their home? And would they have to pay back anything that's due, or how does that work?
Almost in all cases, they have to pay back everything that was due, plus any late fees, any additional, maybe if there was attorney fees or filing fees, something that they did with the county to give public notice that they're going to take your house. So typically, yes, they'll want all that repaid back, and then they'll bring you current again. But there's loss mitigators at every mortgage company. So they have these departments now, not like they did before, and they'll talk to you, they'll negotiate, and maybe they'll make a concession, and we'll bring you current, or we'll add $10,000 to your loan. So every mitigator is different on how they approach to keep you in your house.
So one thing we've heard a lot of here, especially with just not too long ago with our market having some major problems in the housing market, was a short sale. How does that differ from a foreclosure, and how does that work?
Well, this is a very common question. So a short sale, unlike a foreclosure, you actually pay back part of the money. Mm-hmm. So let's say you owe your lender $100,000 and a buyer's only willing to pay, say, $60,000. So you go to your bank and you say, bank, look, will you take $60,000 instead of the $100,000 that I owe you? And it's about a 50-50 chance that they actually agree and say yes. So they'll take less than what you owe. Now, and that's damage on your credit, but it's nothing like a foreclosure. It's much softer in terms of, going forward after, say, your foreclosure or short sale. A short sale is much easier to get a new loan or to obtain new financing than a foreclosure, because a foreclosure is a complete breach of contract. You didn't pay, they took your house. Whereas a short sale, lender, will you take part of the money back? And they agree to it in writing, and that's very important because they agreed to it.
So it's somebody an owner of a home, before they were to go into foreclosure, they would have to go out and find a buyer then?
Yes, you would list your house and get a buyer and let the buyer know, look, I'm not sure if my bank's even going to take this, but if you're willing to hang out with me for a month, 2 months, sometimes 6 months, you can ask anybody these stories about waiting for a short sale offer. But if they take it, usually it's a decent deal for the buyer to hang in there. And for the seller, it's a great deal because it's not as damaging.
Well, that's good then that there are options. As far as bankruptcy goes, how does that get affected by a foreclosure or by a short sale?
Well, on certain short sales, if there's a second mortgage or even on a foreclosure, in certain situations on your second mortgage, if you took out a second mortgage after you bought your house, in Arizona, the bank can come after you, even though they can, you say, take my house, but if you took it out after the fact, they can come after you and sue you personally for that money. So if you took a $25,000 loan, let's just say in this case, to go on vacation, they can sue you for $25,000. If you took out a $25,000 loan to put in a pool, they can't sue you. So a lot of people, what they did, if you were getting sued, they would file bankruptcy just to eliminate the lender suing you for all that money.
Wow. So if you are filing a bankruptcy, you do have to get rid of your home, correct? Or is that something
Not necessarily, yeah.
Okay.
You can include it in the bankruptcy, but you don't have to have it as such where you actually lose your house. So you can still make payments, you can keep your house.
Okay, how interesting. I know this is, again, things that people probably encounter every day.
Every
so
single
many
day.
questions.
Yeah, there's a huge disconnect from the consumer and banks. And every single time the consumer thinks logically, and the bank does the exact opposite, So it's just like, well, you're the bank, you're standing right there. Yeah. And it's like, oh, it doesn't work like that at all.
So in your experience, though, do you find that if people will go and talk to their bank or go and talk to their mortgage officer or loan, are they usually willing to work with people, or is it a 50-50, or how does that work?
You could say it's a 50-50, yeah. It's never the same. It just depends on the bank. If they, if you remember, the FDIC took a lot of banks back during 2008, 2009. If they did, they already pre-negotiated a lot of these mortgages, so if someone comes to them, they're willing to work with them. If it's a bank and and they see your house is actually something that they would want, then a lot of times they may just take your house.
Goodness.
Yeah.
Well, it's a shame they wouldn't be more willing to work with people. It's like if they're trying, right?
Yes. Yeah.
I'm sure. Well, that's where someone like you probably would come in and help and figure things out. As far as interest rates,
Yes.
where are they right now, and how is that fluctuating for people that are looking into buying homes?
Well, historically, interest rates are fantastic right now. They're not as low as last year, but they're still in the low fours, which if you looked at any other loan out there, from credit cards to auto loans, when you can get your home loan in the low fours, it's still historically 99% better than it ever was. Last year, rates were just at a record low. They were in the low threes. So it's a little bit higher than last year, but still awesome interest rates. And the way that we see it right now, it's going to hold steady in the low fours for probably quite some time.
And so if somebody were to foreclose on their house or short sale, how long is it till they can buy again?
Well, this is the most often asked question. This is what everybody wants to know. So it's a little bit different, and most of it stems on how much you have for down payment. So let's start with veterans first of all. So if you're a vet and you served in the Army, you can buy 2 years after foreclosure, short sale, or bankruptcy. And so it's only 2 years. What's great about it being a veteran is there's no down payment. So that's by far the easiest for anybody. Is if you're a veteran, you can buy 2 years after any of these events. Now, if you have 3.5% for down payment, it's going to be 3 years after a foreclosure, a short sale, and only 2 years after a bankruptcy. And this is called an FHA loan. This is the most successful first-time home buyer program in the history of the United States. It's been around for well over 50 years. It's only 3.5% down. And this is a great door opener. Now, if you have 20% to put down, you can buy 2 years after a short sale on Fannie Mae. Otherwise, they make you wait 7 years after foreclosure on Fannie Mae.
Wow.
Now, the stigma in America is Fannie Mae made a big noise out there. And they said, anyone that forecloses, we're going to wait 7 years for you to buy a house again. And that's what stuck in the American public. So veterans, first-time home buyers, everybody believes that it's 7 years, and it's not. It can be as little as 2 years, 3 years, or 7 years in certain cases.
So veterans, though, have that option. They don't
Yes.
have to have anything down. 2 years later, they can go buy a home again.
Exactly.
What a great piece of information. I'm sure that there's so many veterans that are just watching right now that probably had no idea, because that's not something that's just out there.
Yeah.
Although it probably is if they research, but still finding.
It's surprising how many people don't realize, you have a lot of people that have bought 7 houses, they've never used their VA, and now they're going, oh my gosh, I served 30 years ago. You mean I can still use it? And yes, it never expires. You can use it anytime. In addition, you can refinance into a VA loan. So if you have some loan that you're really not happy with, because the VA carries really low rates, it's a great refinance tool as well.
Wow. And so whenever you're using the FHA, that's a federally insured loan.
Yes.
There is something that goes along with that. Isn't there an insurance or something that goes along with that because you're paying the lower down payment?
There's 2 types of insurance policy that goes on an FHA loan. There's the upfront that gets added to your loan, and then there's the monthly. And they're actually both expensive. The good news is later on this year, there's a new program coming out from FHA for pilot areas, Arizona being one of them, where they're going to reduce it by 0.5% for both. Wow. And this is tremendous savings, and we're very excited to welcome it to Arizona to help our people save some money.
Is Fannie Mae the same way, or does that not require anything?
Fannie Mae does have mortgage insurance, but it's a lot different than the government mortgage insurance. So this is private mortgage insurance, and these are typically publicly traded companies that are willing to participate in the risk with Fannie Mae, and these are only for people with less than 20% down. If you have 20% down or more, there's no mortgage insurance.
And as far as FHA go, is there requirements with the amount of money that they will loan you? Like, you can't go buy $1 million house on an FHA loan. How does that work, the tiers?
That's a great question. So on FHA, it's up to $271,000 is how much they'll loan. So you can buy a $500,000 house. You just have to put that much down payment.
Okay.
So typically it's 3.5, which is going to put you right at $280,000 is 3.5% down. Now last year it was about $350,000. So they lowered it in January of this year to $271,000. So that was kind of a bummer for housing. And now Fannie Mae, they lend up to $417,000.
Okay.
Yes. And
so these are resources available for people who have had problems then?
Yes.
Otherwise, there's just private mortgages and things that don't have the same requirements and limitations.
Yes, and all of those are on a one-off basis.
Okay.
And right now, 95% of all mortgage lending is going to be the big, Fannie Mae, Freddie Mac, and FHA. So if you can find something, just understand it's probably going to be negotiated on a case-by-case basis.
Okay, and so if you were to have one thing I've heard about for people that have had bad credit or have had issues with foreclosures is a carryback by a seller. How does that work, and how do people go about doing that?
So yes, a carryback is when the seller, instead of a bank financing you, the seller is going to finance you, and this is totally, a great tool to use. Typically,
if you can find it.
If you can find it, First, you want an intelligent real estate agent that actually understands how to negotiate a seller carryback. Just because it's a little bit of an art form, you have to know what you're doing. So if they have some experience with that, it's going to really help you, because it's a little confusing to the agent. And then really it's just making an offer and seeing if the seller is going to take it. What's different this year than last year is the government's actually involved with a seller carryback.
Okay.
And what I mean by that is the seller has to do what's called ability to repay. So they have to actually follow a government procedure to make sure the person they're loaning to can actually pay it back. The reason is the government said, we had so many problems in housing that we're going to regulate every single piece of it. So even if you're a private party loaning to somebody, you still have to follow the same guidelines that the banks do.
Wow.
Yes.
And that's probably good and bad on both sides, because there is regulation now for both parties.
Yeah, it's all to protect the public, so there's no overinflating or people taking advantage of anybody. So, a seller carryback, they're not loaning to anybody off the street or just saying, hey, if you don't have a job, here's a house.
Yeah.
Sign, it's 50% interest rate, and because those people could easily take advantage. And so the government comes in and wants to slow it down ultimately.
Okay, very good. Well, thank you so much, Dean, for all of this wonderful information in the first part here on Joy in Our Town. And thank you so much at home for for watching. If you have any questions, Dean's information has been put at the bottom of the screen periodically throughout the program. We will be right back after this short message, so don't go anywhere.
Shell shock, psychoneuroses, battle fatigue, PTSD. So far as combat is concerned, I think the stress is going to be the same in any kind of a war.
I think it takes strength to recognize that you need help and to get the help.
Ask your squad leader, platoon sergeant for help. If you get shot up, you don't hesitate about going for treatment. A lot of times you can be wounded in your mind. There's nothing wrong by bringing that to other people's attention and asking for help.
Hello and welcome back to Joy in Our Town. I'm your host, Vanessa Rose. So happy that you stayed with us. If you just happen to be joining us, today we are speaking about economy, and we are joined by Dean Wegner of Academy Mortgage, right out of Scottsdale, Arizona. So thank you so much for staying with us, Dean.
Thank you, Vanessa. Yeah.
Pleasure to have you. Every time we have you, such great information. We just spoke about foreclosures and after foreclosure and mortgages, and touched on so many different things that I know that I hope you have your pen and paper ready, because there's going to be even more great tips here, because we are going to speak about damaged credit history.
Yeah.
This is something that I think applies to so many people today, because credit cards are a plethora, and homes and foreclosure and debt, and maybe people living a little beyond their means sometimes, and so we get into these bad situations, and this is something that you specialize in.
Oh, yeah.
Is helping people with their credit history. So how do people go about fixing their credit? How does that even begin? Is there even a way to do it? You hear of these miracle programs that will erase your credit history and start over. Is that even real? Is that possible? How does that work?
It's definitely possible. And here's one thing, that should be mentioned. Anything that some company that says they're going to help you with your credit, you can ultimately do yourself. And so there is credit restoration companies. They charge a fee for it, and it's an upfront fee and a monthly fee. Typically, it's 6 months. And really, they're just going to do any techniques on the Fair Credit Reporting Act is really what they're going to do for you. A lot of times, that's fixing old negative credit. And what really people need to understand, if you're sitting there and you're going, you know what, my credit isn't the greatest. I'd like to get a better car. I finally want to buy a house. If this is you and you're getting that motivation, what I would say the first step is to pull your credit and look and see where your credit actually is and find out what's keeping you from going forward. And so is it collections, charge-offs, judgments, tax liens? Did you have some bankruptcies? See where you're at to get a benchmark. Annualcreditreport.com is a great place to get it. It's free, and you can get up to 3 reports a year, one from each bureau. So you can get that, read it, really understand where you're at. And so the equation really is 50% is fixing your old negative credit, and the other 50% is establishing new credit. So I see people all the time, oh, I paid off everything, it's all off, it's fixed, and my credit isn't good. And it's like, well, you did half. You need to go get some new credit. Well, I have bad credit. How am I supposed to go get new credit, right? This is such a common question.
It is, yeah.
How am I supposed to get credit when I don't have good credit? And it's really amazing. What came out in recent years, it's called a secured credit card, a secured credit card. And basically, you pledge to a bank, you give them $500, and they give you a $500 credit card. Now, what you want to find out up front, it's so important, and I can't tell you how important this is you want to make sure that they agree to report to all 3 credit bureaus. Now, it's really caught on that this is the hot ticket that the public wants. So you'll see a lot of times on websites, like, we will report to all 3 credit agencies, and that's what you want. There's quite a few. And so again, how it works is you send them $500, $1,000, $250, then they send you a credit card. You really want to get 3 of these. You really want to get 3 of these. And then you want to use those lightly. And then you're just going to, use them a little bit. You might even want to carry a month. You pay the minimum payment. Then the next month you pay it off. You don't want to get in credit card trouble again. Okay,
No.
that's part of it. Is let's not get in trouble. So, and then you use those lightly, and you're going to find that within, 90 days, you should get 50 to 100 FICO points just off of that effort alone.
Wow. And that's something I actually myself went onto that annual credit report to look at it, and it's so much more than just paying off credit. It's how many accounts do you have? How old are your accounts? There's so many things that as consumer, it's just almost overwhelming sometimes, because you see all these things that make the perfect credit score. You could have 1 or 2 credit cards and paid perfect on them even, and you still don't have a very good credit score because you don't have enough accounts. So like you were saying, it's just making sure that you pay attention to the whole picture.
Yes, and depth of credit. I tell a lot of people, look at your credit report. Do you have a boat or do you have a ship? And so if you have a boat and you're 30 days late, well, that's just like a wave hitting your little boat. It's going to top you over. It's going to be disastrous. You're going to lose 75 points just by being 30 days late on a credit card. Now, if you have a ship, which means you've got a lot of credit, you've gotten a lot of credit cards. Remember, responsible. This means you've paid it all back. But you've got a lot of trade lines. You've got a lot of accounts. You paid everything back. If you messed up one month and you're 30 days late, you might only lose 15 to 20 points.
Wow.
So the more depth of credit you have. So once you do get up and running, you really want to always open up credit. So it's counterintuitive. Every, say, 100 days, you should be opening up a new credit card. It's only like three and a half a year. Because after 7 years, remember, inactive is going to fall off. So you might go, 10 years ago, I had a bunch of credit. Now you pull your credit and you have no credit. And you're like, my gosh, what happened? Well, after 7 years, it all falls off. So it's okay to reestablish new credit. It's a good thing.
So if you don't use a credit card anymore, though, should you leave it open or should you close an account?
Great question. Leave it open. Leave it open. Because what happens is the factor says, Vanessa's got $300,000 worth of credit cards available to her. She only keeps a $500 balance. She's never been late. You're golden. Whereas let's say you have $300,000 in credit, you owe $350,000, right? And now you're late, your FICO score is going to go right down to 2.
So that's the debt. I've heard that a few times in going to get a car and things, the debt to income ratio. How does that work? Is that reflected in that?
Well, debt to income is if they know your actual income, and that won't be disclosed on a credit report.
Okay, so that's if you're going to buy a house or a car, then that comes into play.
Right, yeah. They look at how much you make and how much the payment is and see if it's affordable, and then they have guidelines to let you know if you're fitting in the box.
Okay, interesting. See how
Yes.
you confuse the two. How interesting.
But it's a available credit ratio.
Okay.
Is when you have, what we were saying, 100,000
high revolving credit.
And you're maxed out. Everyone understands the term you're maxed out on your credit cards. Well, historically, the FICO model sees that when people are about to file bankruptcy or when they're about to default, what do they start doing? They live on their credit cards and they start applying for more credit. So that's why credit inquiry is not good, and that's why being maxed out on your credit cards isn't good, because that's the pattern right before somebody does a major default. And so the FICO model is so sensitive, Vanessa, that you could go from a 700 to a 600 in 30 days. And then the banks see it and they're like, you're a 600, you're a high risk, sorry, we can't lend to you.
Wow, what is the scores from bottom to top? What is the scores that you can have?
Well, it's a little different for all three.
Okay, what is the most common credit bureau, though, that is used?
Experian is really big in Arizona.
Okay.
So a good credit score would be 700 and above.
Okay.
800 and above means you're like,
an angel.
Yeah, right. You got background music and the sun's
exactly.
shining on you in the cloud. It's amazing. But 700 is really good credit. FHA loans go down to 580 now. Wow. VA loans go down to 580, which is really a D plus credit score. You're not allowed to have any lates, last 12 months. But just because you have a lower FICO score doesn't mean you can't buy a house or even get a car loan. The credit unions are very flexible for car loans. Capital One's very flexible for credit cards. Like I said, FHA and VA are very flexible to get a house. So just because you think you may have bad credit, get with a professional. Have them look at your credit. And if they can't, maybe they're not saying not now, but maybe they'll say when.
Yeah.
And a lot of times what we found is, within 90 days to 6 months, people typically can get back on their feet and finance whatever they want.
Wow, and that's so there are options, and I think people probably might think maybe they're even worse off than they are. They might not understand how it works, and so they might think that that's worse than it is.
It's more often, and the squeaky wheel gets the oil. So even with people that have bad credit, they keep applying and trying and figuring it out. They learn a little bit, and ultimately they'll get their house or their car, or whatever they want. So just, don't give up.
And we have just 1 minute here, but I just wanted to discuss job history and how does that affect whenever you're dealing with credit?
Well, job history is everything right now because so many people went through hardships during the recession, and they lost their job, they couldn't pay it back, and they lost, their car got repossessed or their house got foreclosed on. And so lenders really look at job history right now. And so good job history is you've worked at the same place for 2 years or greater and your income is steady. And that's really what they're looking at. It doesn't mean you can't have 5 jobs in the last 2 years, but why are you a job hopper? So ideal situation is you've been at the same employer for 2 years or greater, and your debt to income ratios are around 30%, which means whatever your income is, about a third of it can go towards your house payment and your cars or things like that.
So they want to see, it sounds like for, I guess anyone, think about it. If you had a family member, someone that wanted to lend money from you, you want to see consistency and responsibility in somebody who stays consistent to what they're doing.
Exactly, yeah.
So it is fixable and it is doable. I wish we had time. I would have loved to talk about the difference between 1099 and W-4 employment, because I know that's a big impact whenever you're buying things and using credit. But you always have so much information, we never have enough time.
I know.
So we will definitely have you back to discuss. But I hope that you've enjoyed this segment of Joy in Our Town. If you have any questions, I know that Dean's office would be happy to answer them. You can reach them. Their information is at the bottom of the screen throughout the program. Thank you so much at home for watching. Thank you so much, Dean,
Thanks, Vanessa,
for joining us and all the great information that you shared. I hope that you've enjoyed this segment of Joy in Our Town, and we look forward to seeing you here next time. Go and have a wonderful day, and we will see you next week.
This program has been sponsored by the Trinity Broadcasting Network and is made possible by your telethon dollars. Your continual support can keep Joy in Our Town coming to your home every week. Write to Joy in Our Town, Post Office Box A, Santa Ana, California, 92711.